Hey traders, Raghee here. Welcome to Charts and Coffee. Happy Monday, everybody. Hope everyone's doing well. All right, so let us get to it. Thanks as always for joining us. We're coming up on about a year now. I think September or October will be a year of Charts and Coffee. So thanks, everybody. I appreciate you guys taking out time, bringing your questions. It's been a blast, and I'm looking forward to year two with y'all. All right, hope you had a great weekend. We are waking up to some interesting volatility for sure. I'm sure there's a lot of questions about, three big markets, US dollar. We'll take a look at the euro and yen, bonds, which those of you know, we took advantage of an uptrend retracement by the dip. And then, a lot of chatter about gold from what's going on at JP Morgan to the move to the downside. I'm happy to cover all of that and more. All right, so let's get to it. First question. Hey there, Sean. You sure can tell you've got your VWAP max right when your next anchor bounces up and neat stuff. So, Sean, you know what's really cool? So when we did the submarket sonar class, and that's probably my favorite name for any of my classes because the title really does give you an idea of what it is, right? Submarket. What is below the surface? What is it that most traders just don't see? Most traders begin and end with price-based indicators, patterns, trend lines, whatever. But below that are three other factors: time, volatility, and volume. And volume is that submarket sonar. So you're absolutely right. Good for you for putting it on your chart. Anchored VWAPs, that's the way to go. Rolling VWAPs, not so much. But anchored VWAPs are pretty darn magical. I completely agree. All right, so what do I think of UNH? So JMO, I think we've got our head mostly in the same spot because UNH is a huge component, a heavily weighted stock within the XLV. And XLV is a long position that we put on last week. So if I'm long XLV and you're looking at UNH, it's just the difference between a boat, the individual stock, and the tide. Now, why do I use that analogy? Because tides affect boats. Now, the bigger the boat, the more the boat can fight the tide. But at the same time, if you've ever been on the water, some days you'll see that there's a lot of chop. And it's just because it's a lot of boat traffic, and a lot of times a lot of big boat traffic. And boats can affect the water as well. So I love that water analogy. Of course, I've been working on the water. I started working on the water back when I was, 18 and a half, 19 years old. So I love that analogy. It does work. And so the only difference between what we're talking about, my friend, is the boat, a ship, really, if you want to look at it that way, and then the tide. And I'm in the tide. I actually like the structure of the tide a little bit better. One of the things that when the market starts to correct, and this is always something that aggro entries are going to be susceptible to, and that is whether or not the corrections are in sync. And we'll get into it, I'm sure, pretty naturally as we go through the month, because we're going to see probably some more pronounced corrections. Okay, Rob, we all want to know what the heck happened to gold. So let's start with what we do know and not get into JP Morgan or the $4 billion order and whatever else is going on. Shenanigans for sure. But let's remember one thing. Shenanigans aside, gold has not been trending. One of the challenges with gold not trending, when you have this kind of movement, right, is that you don't have a dominant psychology. That's number one. This candle right here, that was not a big deal for me because we were still trading above this Darvis support, all right? But most of my trade, this is the second time around that we were looking to do this, most of my trade was factored on getting in around this level, right? Now, those of you that are in the Sector Secrets or even in the futures room, and I'm happy to cover this next time I see you all in the chat, please keep in mind that when we gap through our entry zone, which is exactly what happened, we gapped through the entry zone, okay? When that happens, you've got to wait. You've got to shut it down. You've got to say, wait a minute, I had a level of support. The market opened below that. Do I really have an edge in this market? Do I really have the clarity that I thought I had, right? Based on, here we go, based on that. And we didn't. So those of you that, we talked about this on Friday, I believe, inside day or a minor low. And until I get one of these two things, I'm going to have to wait. Inside day or minor low. So I think it's really interesting that we've snapped back up to this level that I thought was so important. Isn't that interesting? So, I mean, shenanigans afoot for sure. But really, the warning day was this day right here. Breaking the volume ledge, breaking this support zone. That's the warning. That's the, okay, hang on. What don't I know about this market, right? That's the exclamation points. What don't I know? So that's the way we looked at it. And that's, you know, how we covered it in the futures and the sector secrets room, which is, and think about this, when you have an entry zone, of course you have an entry zone that should precede your entry, right? When you have an entry zone and we gap through that zone, shut it down. It's okay. Don't average in. We don't know what's going on. What I saw on Friday's candle, and we spent a lot of time talking about this, from charts and coffee into sector secrets, is I lost my edge. The clarity that I thought I had, I do not have any longer. So I hope that makes sense. All right. So next up, good entry for CL. James, how are you? I think we're in an interesting zone now. Yes. So remember, we have a chop. Here's our support. Here's our resistance. All right. That's the near term range. The first thing that I like to do is just cut the range essentially in half, right? So we can cut the range in half. I'm just eyeballing it here. Okay. Then I'll cut that range in half too. So what you have is the top half, right? And then you have the bottom half. Then you have the bottom quarters, right? And then the lower we get within that, where we are right now, the bottom quarter, the more this is actually a conservative fade, the more it's a conservative fade for us. So yes, that is something that I'll be likely keying up via USO very soon, if not today. And we'll get in, again, not as large with the position size because it's a non-trending market. You know, my confidence in XLK, XLC, XLV, those uptrending markets, TLT, right? My confidence in those, because they're double green, then lends to larger position size. And as a general rule, larger position size is merited in trends, not in non-trending markets. I will always presume, regardless of what my secret squiggles are saying, I will always presume that I have less of an edge in a non-trending market. Okay. So wonderful. I mean, excellent questions. All right, let's keep going. Yeah. Is Jackson Hole part of this? Oh gosh, you know, you guys are asking wonderful questions. We've got Jackson Hole. We've got summer doldrums. We've got seasonals. We've got a lot at work in the markets right now. And then again, we also have clarity, and we have a trajectory. We have a path where the Fed says we're on track for taper by the end of the year. I think the equities markets can handle it. I don't think the equity markets fall to pieces because we start to trim back the $120 billion we're spending. Now, taper doesn't mean it goes away. Taper means we just won't be spending $120 billion per month. Mind-boggling number. The equity markets, having known this is coming, will start to discount it, factor it in, and it won't be a shock. However, it's not, you know, the punch bowl's been spiked. Now it's going to be a little less spiked. It's not like we're not spiking it at all anymore. It's just going to be less spiked, right? So I think you combine all of that, you've got a pretty good reason for August maybe to give us a pullback. And by the way, oh gosh, when I saw the markets heading lower last night on the open, I was so happy, because one of the things that we have been wanting is a pullback to the 21 exponential prop dot, a pullback to the 34 EMA wave, so we can do like we did back on the 19th and buy either the broader indices, you know, get long calls, buy XLK, XLC, XLV, maybe even XLY. I have a number of these on my, yeah, YVCK. I would love for a pullback because as a trend follower, a double green market trend follower, when we get these corrections, I mean, that's the opportunity. That's the opportunity. All right. So next question. Great to see everybody. Covered some gold and yeah, were our calls for September, the GLDs? Are you talking about the TLT or the GLD? GLD we never fired because remember, we had gotten in, scaled out, got stopped out at break even. And look, I'm going to tell you something that most traders don't say, and they should, because they should admit when the market is gives them a little drop of luck. The fact that we were able to get out of that first gold position wasn't all luck. I mean, we were using major psychological volume derived levels. So when those levels got hit, getting in around 18, getting out at 1835, getting stopped out to break even, all that's technically in price and volume merited. But, I think getting caught in that move to the downside, sometimes luck plays a factor. And I will knock on wood, everything we do in the markets is not pure skill. Sometimes it's luck, good and bad. And it happens. It happens. The less we acknowledge that, the more we're probably deluding ourselves that, the market isn't always out to get us. It's not out to get us at all. It doesn't even know we're there. These are just these huge forces at work. Don't turn it into a conspiracy theory. It's never going to serve you. The markets have been behaving by the way, the move in gold, we saw a move like this last March, if I recall. I believe it was last March. It was just over a year ago. So it does happen. These things do happen. But remember, the difference is gold was a non-trending market. So thanks for the question. Am I interested in XLE? Michael, I'm not. Until I get a better read on crude, I am actually not going to venture into oil stocks, XLE, OIH, or I'm not going to look at XOP either. All right, so let's see. Next up, hey there, Foxtown. Yes, you told us that Friday. I said wait. Yeah, I'm not saying wait because I'm prescient. I say wait because I've got no stinking idea what happens. Like, look, we have a blueprint, we have a plan, we have a path. And you ever ignore your GPS and think, I know better. I'm going to make a left here instead of wait to do what the GPS says. And then what does the GPS do immediately? It says recalculating. In other words, we veered off the path from what the GPS laid out for us, and it's going to recalculate. And that's me, right? When I veer off the path, when the market doesn't behave according to my trading plan, my brain, literally, I imagine that little GPS. I don't even know they do them anymore, but I imagine the GPS screen with the big letters at the top going, recalculating. That's what we've got to do. We've got to recalibrate, got to recalculate. So thanks for that. And remember, it's okay. It's okay to take a loss. It's okay. One of the things we talk about a lot in the rooms is take the paper cut, right? Take the paper cut. It's supposed to sting a little bit. Trauma teaches. Let's make it a small trauma, right? Take the paper cut. Don't lose a finger. So I don't mind taking small losses. We've got to, people in my position have got to talk about taking losses. I'm just not going to shove it under the rug and say, well, the option expired, worthless, or I'm going to risk the entire debit. That's just dumb. There's no reason to, because when you mathematically look at coming back from even a 50% down on your, even a debit, because that's what I usually do, long calls, it makes no sense to hold on after certain levels on the chart and after certain losses of premium. So why would I just sacrifice my hard-earned money in the market? Take the L, take the loss, move on, right? I'm not looking for an undefeated season. I think that hurts more traders than not. Okay, so next up is, what indicator do I have at the bottom of the chart? Well, there's two. On some platforms, I've overlapped the two, but this is my creation called the V-score, and this is called the JT multi. Volume tool and trend tool. This uses the VWAP, standard deviations of the VWAP. So you run a Z-score in the VWAP, and this is the 8, 13, 21, and 34 EMAs. I always like to let you guys know what powers these things. You got to know what's under the hood. You got to know what it's capable of, and I don't like black box nonsense. So one's a VWAP-based tool, one's an exponential moving average-based tool. All right, so platinum, I have not been playing metals all that much. I mean, we've been in and out of gold a little bit, but gold really is a play on real yields. And then for me, I've been avoiding most of the metals, including my beloved copper. I need better clarity out of the bonds, apparently. And I need the US dollar to sort of get out of the way, because the dollar's been, I think, back and forth with the influence on gold. I mean, gold has this sort of, we have a triangular situation where, yeah, for the most part, gold is a play on real yields, but gold also has an intermarket correlation that does come and go, as all intermarket correlations do. It's an inverse or negative intermarket correlation. So dollar strength is going to be a drag on gold. I'm not blaming the dollar on the move in gold, though, not entirely. And clearly, we're long bonds. We just bought them on Friday. We're long bonds again. So that's looking good. But clearly the real yield gold narrative is wobbly at best. So yet another reason why I have terrific clarity on continuing to roll with bonds. This will be what, the fourth long we've had since June. So 1, 2, 3, 4. Yeah, fourth long since June. Clearly it's not helping me in the gold situation. All right. So there's that. As far as RBOB goes, look, the more clarity I have, in the, here we are. Give me 1 second here. The more clarity I have in the crude oil market, the more confident I am with RBOB. UGA is the ETF alternative, and it's actually ridiculously illiquid, problematically illiquid. So as much as I would want to do that, but I'll tell you what, as much as we've talked about crude oil and RBOB gas, let's not neglect the tall and awesomeness of natural gas. If you're looking to focus on any kind of energy stock, let it be one related more to natty gas. If you're looking at an energy play, let it be more related to UNG, to NG futures. Now, I don't recommend most people play NG futures. It can be a wild one. If you're comfortable with that, that's fine. But let me just show you, for example, how do we calculate risk and understand risk? We dollar denominated. So if you take a look at NG, and it's really not cost prohibitive to trade in terms of initial margin. It's under 3K. But let's talk about the range from where we are now to the bottom of the validity of the trend. Our point of validity for the trend is about $3,300 away. If we wait for the 21 EMA, it's 2K. We wait for the 34 EMA on the high, it's about 1,400. So this is how you can start to ask yourself, what's the risk associated with the trade? That's going to determine your position size, or whether or not it's even affordable for you to enter this. Not affordable because, well, Raghee, yeah, I can afford the 2,700 initial margin. That's not affordability, my friends. Affordability is, can I afford to be wrong? And humor me this week if you've never done this. Take a look at the trades you're taking and ask yourself, can I afford to be wrong on this trade if I get stopped out? And if you can, now you're taking a step forward into really proper risk and trade management. All right. So, yeah, for those of you saying with the Fed, green lighting, yeah, I completely agree. Financials, I see a question about KRE and financials. I will pass on those right now. As much as I would love to get long and play these, I will pass on these right now. I know they just launched higher, but remember, these are not double green. They're arguably 1, 2, 3s. They're arguably just, breakout trades. Be careful. I like to see the breakout, and then I like to see a quick retracement. And if we can play a retracement on the breakout, that could be interesting. But I don't have this on my on my radar. What do we have on the radar? We have XLV. Look at the structure. We have XLC. Again, look at the structure. XLC is a long position right now for us. XLV is a long position for us. TLT is a long position for us. Why? Because these are markets that are double green and we're taking advantage of the pullback. Okay. All right. So that's it for Charts and Coffee for today, for Monday. Thank you, as always, for being a part of the Charts and Coffee crew. All right. Have a good one. I'll see you tomorrow. Same time, same station. Be good to each other.